Good morning, making moves. It's Tuesday, so your favorite host, Tim are back. 10 o'clock not on the dot today. We're a couple minutes behind. I'm sorry. I was setting up my screen for today's presentation, so I'm sorry I'm a little behind, but I think you're really going to love what we got to talk about today. Hold on, I'm putting these on do not disturb. We just got back from a mastermind in Ponte Vedra Beach, Florida. And that was a lot of fun. And we learned some really interesting information from one of our mentors. And I felt like this information was just so damn good, I had to share it. What do you think, Tim?
Yeah, no, I really do. A lot of good insights shared, and honestly, man, like the guy that was sharing them, I when he posts, I listen to it. In fact, I think I've shared some of his stuff before. So
I share his stuff all the time. So I want to come out and say, full disclosure, I didn't come up with this information. I didn't come up with these slides. I didn't come up with a lot of these things. But after hearing it and being exposed to it, I now have learned how to think about this situation. And the situation that everyone's talking about is what is going to happen to occupancy rates and what the hell is going on with the financing market right now. Do you agree?
yeah, I completely agree. I mean, hell, we're buying something right now, and that's the. I think you were on the phone call with our lender yesterday. I think that was one of the things he was bringing up were rates, rates, rates. Everybody's talking about rates.
Yep. Yeah,
Um,
I was on the call yesterday. I was talking to him about something else I was looking at, and we kind of went down a tangent, started talking about the deal that we have under contract, and it was like, hey man, when are you guys going to lock this rate and get me all the information that you need? Because the Fed announced they're going up another 50 basis points, half of a percent. People that don't know, a bip or a basis point is 1/10 of a percentage. So 50 bips is half of a percentage increase. So he's like, hey, man, Fed announced they're going to raise the rates another 0.5%. So, I wouldn't be surprised if you start seeing some rates in the in the sevens. He was like, for your underwriting now, he was like, use like 6.75, but a week or two from now, if I tell you 7, don't be surprised.
and guys, just to create panic, right? Like let's do our media moment here, right? Like to create panic in everybody's mind, right? So we've had this property that we were talking about under contract for about a month now, and our underwriting over the last month has gone from 5.75. Now we're at 6.75, 7%.
Yep.
Right? We're going to do the Kramer thing. Crazy, crazy, right? So you got to go. Hey, you got to be aware of the rates, but Tim's getting ready to share something here where we're talking about rates are a factor, but let's look at what the market's doing right now.
Yeah.
Regardless of rates, let's see what the market's doing. Right.
Yep. Yep. All right. Oh, Richard Gamble. I follow some here. Let me bring it up here. I follow some economists who are predicting negative Fed fund rates by March 2023. I'd be really interested if you could share that article or some kind of information with me because I'd really like to read that and kind of learn a little bit more about it.
Yeah, and one thing on that, like, hey, Richard, that would not shock me. That wouldn't shock me because we're seeing it. We're seeing it in the market right now, right? The Fed's yanking on that lever. They're yanking, right? 50 points here, 50 bips here, 50 bips there, and the stock market is responding. Has
Oh
anybody
my God.
noticed? Has anybody noticed the last 2 Fridays in a row what's happened? We're going down. Like we're going down.
Tell him
Uh,
what you told me in the car when we were driving down to Florida, though, because I don't follow the stock market. Full disclosure, I have absolutely no money in the stock market at all. I withdrew my 401k. I have no money. Everything I do is in real estate.
Yeah, so guys, I follow the stock market. I do have some things in the stock market because I still play around in there from time, but just because I like to buy certain companies on the dips. For instance, I bought Tesla at the beginning of COVID because
Mm.
there are certain fundamental companies out there that I look at and I go, COVID doesn't change their value, right? So anyway, that's not why we're here. Um,
Tell me you're a rich man without telling me you're a rich man. I bought
I
Tesla before COVID.
I wish I was a rich man. I also with stocks I also follow my gambling strategy, and if I bet 100 and I'm up 200, I put 100 in my pocket. So
Hey,
um,
yeah, take the money off the table. Richard,
yeah,
thank you for the link. I'm gonna have to watch that YouTube video and educate myself a little bit about it.
So one of the things that, and we won't go too deep into this. If anybody wants to chat about it, reach out to me. But
Mhm.
because we really want to get to what Tim has. But basically, the stock market's in kind of a little bit of a free fall right now because of what the Fed's doing. They're panicking, but there's some other things going on too there. And if you look at anybody who has a savings account, it has actually cost you money to save your money over the last 18 months. I don't know the exact number, so please don't anybody flame me for not being exact on that. So, it is caught. If you look at the interest that you're earning and the fees that you pay, you're paying more in fees than you're earning in interest. So, over the last 2 years, people have recognized that, and people that don't traditionally invest in the stock market said, oh crap, I've got to find somewhere to put my money. I'm losing money. And so all this money that doesn't traditionally go into the stock market, and this isn't the Fed printing money, that's a separate issue. This is people with money in their savings accounts. People have been taking that money and investing it in the stock market. So the stock market has had record numbers of capital infused into it, not just from the Fed, but also from people like us who just have savings accounts, who are looking for places to actually grow their money. And so all this money that doesn't traditionally go into the stock market has been flowing into the stock market. And now that rates are going up, supposedly savings rates will go back up a little bit. The stock market's coming down. People will probably panic like we always do. They're going to start pulling their money out of the stock market and putting it back into savings accounts, which is going to compound the issue that's going on in the stock market. So, just something to keep in mind, guys. Like when you're looking for places to invest right now, and Tim's getting ready to share some information with you that will talk to, hey, interest rates are what they are, but let's look at the actual metrics within the market and what rentals are looking like. So if you're looking for places to pull your money out of the stock market and put it, we may have an idea for you.
Yeah, so we're going to talk about essentially macroeconomics, right? And for those of you that are syndicators, and I think most of you are, or if you're raising money for your private investment deals and things like that, um, that's a really good part of your pitch in educating your investor of why it's good for them to invest in real estate. It's a long-term asset that you can't see the price fluctuate up and down like the stock market, and it removes a piece of anxiety because you can't see the value fluctuating all the time, right? It's better to take the money out of your investors' hands and put it into something that they can't touch, because otherwise, when you do have these dips in the stock market, you're going to have people panic selling, and then they're going to lose money. But I think of somebody in my very close family that had made a post about recently retiring and then saying, "Oh, he picked the worst week to retire because the stock market was down." And I was just like, my real estate's still paying me quarterly. I don't know what's going on, right? And it's a really good feeling that yes, there is going to be price fluctuation. There is going to be some changes in the financing market. Your loan to value on your refinances is not going to be 75 or 80% anymore. Like underwrite it at 65%, because debt service coverage ratio is still a real thing. And that's kind of like a separate topic. But getting people's money out of the stock market and putting it into long-term stable assets with fixed long-term debt is the best thing that you can do to help them so they don't panic sell, right? So train your brain to think that you are providing the service for people, because you are. They don't know what they don't know, and it's your job to help them mitigate the risk of stock market fluctuations by putting their money into real estate. I mean, because what happens at the end of the day, if real estate goes down, you just hold it longer. It comes back up just like the stock market, like goes up and down, up and down. You ride the wave, you just hold it longer. But because your investors don't have control over that, you do, and you're a very smart, intelligent investor, you know it's better to hold it than it is to panic sell like your investor could have done in the stock market over the last 2 weeks.
Yeah.
So, all right, rant over. Sorry, I get really pumped up about helping people pull money out of Wall Street, and I think that what we do as a whole is a vital product that we provide for our clients, and our clients are our investors.
Yeah, and hey, just one last thing on what Richard pointed out. Like Richard, back to what you said about negative rates, wouldn't surprise me. Would not shock me. Now, am I going to underwrite to that? No. I'm going to
Mhm.
assume I'm going to assume worse, not better. But it would not surprise me because, hey, guys, we all know the Fed doesn't. doesn't yank on that lever lightly. It doesn't push it the other way lightly. It's almost like all or nothing, right? Like it's a panic. We're going to do this. It's a panic. We're going to do that. So the stock market's falling. It would not surprise me to see the Fed say, "Oh crap, we got to reverse that." So here we go with rates again.
Yeah. Right. It's the only action they know how to do. So, all right. So I'm going to bring up some slides here. Let me share my screen. And first, I want to talk about historical numbers. Boom. All right. I hope all of you guys can see this. So this slide is talking about occupancy rates all the way back quarterly since 1993, right? As of the first quarter of 2022, occupancy rates have reached an all-time high. What does that tell us? It tells us that supply and demand is still wrong, right? Um, Most of you that have learned buying real estate that say, hey, uh, when you have more than 95% occupancy, you're not charging enough for rent. And that's because people are coming to your property. If you're 100% occupied, then you're not charging enough, right? Because people are coming to your property and you have so much supply because your cost is low. All right. So they talk about raising your rents until you hit that 95% occupancy rate. And if you look at it historically, it's somewhere between 90, like, just looking at this graph, somewhere average is between 94 and 95%. Right. So I typically, when I underwrite a deal, I think that it's stabilized. I'm going to underwrite to around a 5% vacancy rate, 4.5, 5% vacancy rate, and then 1.5 to 2% of loss to lease, bad debt, concessions, whatever. Like, you're always going to have that. That puts you in that economic occupancy rate of around 94%. That is a very stable, secure, good way to underwrite your deal, because no matter what you do, you are always going to have some kind of bad debt. You're always going to have not everybody paying full market rent. And if somebody tells you that they're kind of lying to you, or they're not charging enough for rent. Okay. So keep that in the back of your mind. Occupancy rates as of the first quarter have climbed to all-time highs, and it looks like it started. Let's call it here. There was a little bump right here, but it's really Q1 20. Yeah, Q1 20. That's the start of COVID. Since the start of COVID, because of the supply chain issues have made it more difficult to build property, has driven up the occupancy rates, because people are moving out of their mom's basements. They need apartments to go to. They need rental places. They need somewhere to live because they're tired of living in mom and dad's house, right? So this is a really good metric, and I wanted to start with this one because it kind of shows where we're going to be going in the future, of what professionals, not just Tim and Tim who think they figured something out here. These are professionals that look at the market data. They analyze this stuff on a day-to-day basis, and all we need to know is the output of this graph. So the second chart, I guess you can see it over here. You can't read it though. So here's a projection of the future of what near-term occupancy rates are going to be in the future, right? So here's the previous forecast is this little gray line. Can you see my cursor, Tim? Oh, actually, there. Can you see it?
Yes.
Oh, there
Yes.
it is. All right. I had it on the wrong screen. So this previous forecast of Q1 2022, you can see that the occupancy rates, they were estimating that it was going to decline faster than what it currently is projected at. They've increased the occupancy rates because supply chain issues are still a real thing. We are still in a deficit of building apartment complexes and building places to live, houses, things like that. And with how competitive the real estate market is, it makes it more difficult for the average buyer to go out and buy property still. And now with the increase in rates, and what you're going to have is their buying power has gone down, but sellers still want this top dollar number because that's what they've gotten over the last 2 years. So it's going to take a little bit of time. There's going to be a delay. There's going to be a slowdown of transactional volume until sellers can come down on price a little bit, and buyers are going to either overextend or they're going to find different ways to finance debt. And personally, I don't know about you, Tim, but the 40-year amortized loan has been thrown around many times, and I think to kind of hedge against inflation here to make houses more affordable for the middle class.
Yeah, no, I don't disagree. It's out there. And maybe it's just kind of fear of the unknown. Some of that worries me a little bit.
Yeah.
Like taking debt out 40 years. Some of that worries me a little bit, but at the same time, maybe that's just me not being comfortable with it
Yeah.
because we haven't had it before.
Right,
But
right.
we'll
It's
see.
new, it's change, it's different, and that's fair. Like, it's good to label your fears because then that identifies what you need to look into in order to mitigate that risk, right?
Yeah, I'm always cautious of products like that because back in '07, '06, '07, there were a lot of products out there that were basically meant to get people into more than they could afford.
Yeah.
And we see what happened. Like if you went
Mhm.
back to that last thing, we saw what happened. Um, uh, yeah, right there. Hey, guess what happened right there in 2010 was a result of what was going on in 2005 through 2008.
That's right.
Um,
It's
so
all it's math, it's in the numbers, right? It's data, it's pure data.
there's also something else you can glean from that too, if you wanted to. But essentially, people are asking like, what's going on? What's going on with real estate? These prices, these prices. Well, guys, the reason we saw a dip in '09 and 10 is that there was such a building boom with crazy debt options going on in 2005, 2006, 2007 that there was a severe oversupply
Yep,
of housing in this country, a severe oversupply. I
yep.
I remember condos in big cities just literally sitting vacant for years.
And
Um,
that's why the occupancy rate is so low in those periods because there's an oversupply. Now we
yeah,
have the exact opposite. We have an undersupply.
right. So when folks are asking like, where are prices going? Where are prices going? Well, and they're comparing it to 2008 and nine. Well, hey, two factors: lending is different, and by the way, our supply is way different right now than it was in 2008.
Yep, yep.
Um,
Let me see. Can I go? Okay, so now we're back here. So
yeah,
now look at where they're projecting out to 2026, December 2026. They're projecting that the occupancy rate is going to stabilize back at a market the market standard of around 5% economic vacancy, right? Now it's a little higher than what previously, right? I mean, it kind of looks like the average was maybe around 94, somewhere to 94.5%. And now we're looking at a little bit higher than that. But I would still underwrite conservatively and say, hey, I'm still going to write in my 4 or 5% vacancy and 1 or 2 percentages of bad debt and concessions and loss to lease, et cetera, and so forth. So what this does is it provides clarity of where the market's going, right? Interest rates are what they are. I personally wasn't involved in real estate back when rates were 12%, but I know that there's plenty of people out there that you can see in the comment threads on Facebook posts and Reddit and all that other kind of stuff where their first loan was a VA loan at 12% interest and they thought they were crushing it, right? So it's all relative, guys. It's all relative. You just underwrite the deal to what the market numbers are, underwrite to your investor standards, and make your offer price.
yeah,
Now,
completely agree.
so this screen shows renter income continues to grow. Over the last year, it has grown 13% on average. So what does that mean? That means people are getting paid more because of inflation. And now with the rising in the rents and the rising interest rates, debt payments are going to go up. Rents are going to continue to go up because the rise of employment, the rise of how much people are getting paid. 13% year over year is a huge number. That's far faster than the rate of inflation right now. Inflation
Yeah,
is what, 8%? And you got 13% year over year increase in pay.
yeah,
That's a good thing, right? Now, you watch the news. I don't personally watch the news. I haven't watched it in years, but I know that the news is using fear tactics, and they're sitting there telling you, "Oh, everything is so bad. Everything is going to shit. Everything's going to crash and burn," because they want to incite fear. Fear sells. That's what the news is all about. They want to sell that fear so that they can drive whatever their agenda is. Because let's be honest here, folks, politicians and all of these lobbyists and everything, they make laws for themselves, right? So, they just follow what they're doing and think about it critically, not just what they're telling you, but think about it critically and compare it with market data is going to drastically change your opinion on what's the state of the market.
Yeah, completely agree. In fact, I just watched a whole thing on the whole. I don't watch the news either, but just watched a whole documentary on the media and stuff like that. And he's right. Fear is a thing. Just use data like this though to get over what the media is doing with fear tactics. Um, so the biggest thing here, and this is one of the reasons why I follow the guy, and I don't know why we're saying the guy. It's Chris Jackson here that showed
Yep.
us some of this stuff, and he's phenomenal. If you're not following him, follow him because like his level of detail and research on this stuff is great.
Yeah,
Um,
absolutely.
and and he's absolutely right. Like these are going up, and it's not just in A class or B class or people with white collar jobs. I mean, this is happening at the blue collar level too. I can give you a practical example that just happened to us last week.
Oh yeah, this is good.
Yeah, so my my business partners and I, we have a property. I'm not going to go into where it all is and everything, but we have a property that's a LIHTC property. And for those of you who don't know, LIHTC stands for Low Income Housing Tax Credit, and that basically LIHTC properties are rent restricted and also income restricted. So I can't, if I'm at 60% income, maybe I'm limited to 30, someone who makes $32,000 a year. And think about that for a second. $32,000 a year. It is very, very difficult in this day and age to find somebody who makes $32,000 a year that has good credit. And that's the tenant you're looking for. You're looking for well-qualified tenants, right? So we were limited to that $32,000 number on income without us doing a thing. Every year that gets reassessed based off median income. So it's a 60% of median income in this particular area without us doing a thing. The housing authority came back and raised the low income level that we could go after 17%. 17% in 1 year. So instead of going after that $32,000 person, now we can rent to a person that makes $42,000 a year. And that's tremendous, guys. I mean, that's huge. But that should also tell you that number's based off data. Like it's based off median income. The median income in that area has gone up, at least 17, higher than that actually. And then with the effect that had on rents is, again, without us doing a thing, the rents that we could go after on one unit in particular, we went from being able to go 725. I think I told you, Tim. I think it was somewhere around 725. Our new minimum rent, our new max rent that we can get on that property is now 950.
And tell them the experience of the one unit. That
Yeah. So
and
that
this
that
is important, guys, because yeah, sure, it went up 17%. You can go from 32,000. Now your person can be making 42,000. But look at the difference in the quality of the tenant and their reaction to
yeah.
being able to rent a unit.
So we had a studio that was listed at 725 because that's the max we could ask for. So we were going out there looking. We could not find a well qualified tenant that made that $32,000 number. So that unit sat vacant for over 60 days, and it wasn't because there was no demand in the area. Is literally we could not find a tenant that met the criteria that we were limited to. So basically, the rules of the housing authority were forcing vacancy on us. As the day that we were able to raise our minimum income and our rents, someone came in, made $41,000 a year, well qualified, good credit score. We told them 950 for that same unit that had been advertised for 2 months at 725. We said 950. He signed on the spot. Not a problem. Signed on the spot. So we got a 12-month lease at $225 more a year with a well qualified tenant right there on the spot. So that's a practical example, guys, of what we're seeing in the market right now. These rents are not going to stop for a while.
Right.
Income is going up quickly, and not just on those pretty Apple jobs that are moving to RTP paying $180,000 a year. Income's going up. One of our brokers called and he was like, "Do you know I just walked out of a gas station in northern Florida?" And he goes, "There's a sign sitting out front that says cashier $17 an hour."
What?
Yeah, this gas station's hiring cashiers to work the cash register in northern Florida at $17 an hour.
Wow, that's
Yeah.
insane. Yeah, but I mean, This information is so powerful. That's why we had to dedicate this show towards it, because there's graphs, there's data, there's factual information here supported by a real life example coming from a LIHTC deal, which is government based, right? The government looks at this data more so than I think anybody. And now that the proof is in the pudding, and you can see it directly by the actions that we're taking by owning a property and seeing what the direct impact is on the market. So this is not like just blowing smoke up your ass, essentially. Like, this is real stuff, guys. And it's something that you need to understand, or at least be interested in knowing and having a well-rounded understanding of what's going on in the market, what's going on with job growth, rent growth, supply and demand, interest rates. All of these things are critical to your investment thesis. All right. So then, this was a really interesting slide saying that twice as many markets have greater than 99% occupancy than less than 96% occupancy. What is that showing? That's showing us that supply and demand is still off. The demand is so high and supply is so low that more property are 100% full than more than double the property is 100% full than less than 96% occupied, right? So again, proof is in the pudding here, guys. Like, the numbers don't lie.
Yeah, and one of the things you can do with that data that Tim's showing right there, I saw a really good piece yesterday that showed, so everybody looks at the real estate market as just like this big thing, right? That it's the real estate market, but we all know here, right? We're all more advanced than that. We all know that the real estate market differs area to area to area, and that different areas are in different cycles. So one thing you can do with this is you can take this data and then you can put it over top of where in the cycle different markets are. Are they in a growth market? Are they kind of coming off that growth and they're coming back into like stabilization or pullback or whatever? And you can start to identify markets where you might want to go start looking. Right. So, hey, we're in a period right now where we're 104 or 100 or 97 to 98%. Well, let me go look at a market that's just starting its growth period, right? So maybe that's where I should go, because at this time, with that kind of metric going on, those are markets that I might be interested in taking a peek at.
Right. And just for those that aren't as comfortable with kind of looking at this graph, I just wanted to point out, everyone talks about, I mean, if you've been ever to a macroeconomic class or anything like that, they talk about a bell curve, right? So you can see the bell curve like this, and the average of your bell curve is going to be at the highest right in the middle, right? So we got 97 to 98% occupancy is most of your property, right? I mean, even it's skewed more. The bell curve is skewed to the right, showing that more property is greater than 97% occupied, right? And the bell curve is less to the left. So what this is saying, twice as many markets with greater than 99% occupancy than less than 96. So that's looking at this piece right here, saying that the sample, saying 36% of the sample was greater than 99% occupied versus 18% of the sample being less than 96% occupied, right? And then this is just your median bell curve, which is still skewed to the right. And I personally think that it's going to be a couple of years before it starts to skew a little bit more to the left and you get back into that 95, 90, 96% occupancy rate.
Yep.
And then our last slide here, and it's just talking about, this is absorption rates, meaning that how many units are being absorbed and occupied by the market than available. And the market is peaking, and it's saying that future absorption capacity is dwindling. People are still renting. I mean, there's still growth. It's going to slow down. It's not going to be, as Chris Jackson said, it's not going to be a red hot market. It's just going to be a red hot market, right? And I mean, the difference is negligible, but the impact is huge, because you're still going to get the rates. You're still going to get the income growth. You're still going to get the rent growth. Yes, the rates on your debt are going up, and all of this information, unless you have this information in front of you, people are getting scared. And Chris Jackson said it beautifully. He was like, yes, people are scared, because that creates opportunity for us to go buy. And Tim, we're still buying, because this data proves to us through our relationships with our mentorship, I mean, our mastermind groups that we're part of, we're learning these things because there's people in that room that are way smarter than us. And I'm just relaying this information because I feel like it is so powerful that everyone should know it. And yes, like there is a lot of scary things going on in the market, but as long as you can mitigate those risks of, well, what is the market going to do? Support it with data.
Yeah. Yep, and good question, Kiki. Typically, I didn't see the criteria behind this, but typically these are all inclusive of market.
Yeah.
Yeah, they don't tend to separate out LIHTC versus market rate, because keep in mind, on most LIHTC properties, there are market rate units on that property as well.
Hmm.
So they don't tend to separate those out. I can't tell you 100%, but I do know traditionally they don't.
Yep. Yeah. So, I do want to. I know that I mean, I could sit here and talk about this all day, guys, but I do want to bring up a couple questions now that we've gone through the data. Oh, I'm kind of breaking up a little bit. First, Robert here. He said that at the finish line of his current deal, the lender's charging an additional 5% on down payment. Yes, we are seeing that in commercial because we had a conversation last week with our lender on this deal that we have under contract, and he was saying, 70, 75% leverage. I talked to him yesterday with the news of the rate going up 50 bips. They're saying, oh, well, now you're probably going to be in the 65 to 70% ratio because of a debt service coverage. The debt service coverage ratio is still a very important factor, guys. Like the bank still looks at your 1.25 debt to coverage ratio. And if you don't meet that, you need to bring more equity to the table. And what does that do? More equity to the table reduces the returns. So either you have to be okay with providing lower returns or you need to get a better price.
Yeah, and guys, keep in mind one thing on that. Like, so this is where, we talk about relationships. This is where lender relationships become huge. Because that's I don't know for sure, but I would guess that that's probably like maybe a broker that you're going to or something like that. I will say that, like when we go out to the general market, we get those kind of blanket, 65, 70, 75%. But like for instance, this past weekend, one of mine and Tim's mentors, their team is experienced enough and has shown enough performance that that's not what they're hearing. They're
Mhm.
getting lenders coming to them going that have worked with them before. They're getting lenders coming to them going, you know what, I'm going to give you 5 years. I'll give you 3 years interest only. I'll give you 5-year bridge product. And I'm still going to give you 80%. And guess what? Your rate's still at 5.5.
Yeah.
So those lender relationships are huge. So
Mhm.
build those, establish them. There is something to be said for finding a couple of lenders and just sticking with them.
Yep. Absolutely. And then somebody else had said renters' income may be rising, but is their purchasing power? That's where I found the issue. Technically, their purchasing power is going down because of leverage, right? The higher the interest rate, the lower that you're able to get for your monthly payment. Now, that is kind of offset and combated with if they're making more money, then they can afford to pay more money in rent. But if you think of it in the terms of absolute dollar, people get stuck on a number, right? Like they don't want to spend more than $1,500 a month on rent or $2,000 a month on rent. And even though they're making 10% more, they didn't increase their budget to spend on their mortgage payment or their rent an additional 10%, right? So that's the, it's, I hate to say it, but I think it's really the consumer mindset is that, oh, I'm making more money now. I want to keep my expenses the same and I want to go on a trip to the Bahamas and buy whatever the hell I want to go buy, right? They're buying consumer debt things with the increase of their with their income.
Yeah,
No,
and
go ahead.
yeah, and Chris talks about it that way as well. So what you as an operator have to focus on is you just have to focus on that kind of like rent to income ratio or mortgage to income ratio, the housing payment to income ratio, and
Mhm.
as their that percentage that they need to put towards it may stay the same, but that percentage increased or that dollar increases as their salaries increase. So that's what you're focused on, not necessarily are they actually budgeting for it.
Yeah, yeah. The easiest way, I just use the term absolute dollar or absolute value because, sure, a percentage and a ratio can go up or down. But if you look at it in terms of how much it costs, like Think about it relative to gas, right? Oh, back in 1990, I was paying $1 a gallon. Like, this is outrageous, right? But they're also making significantly less money. Like, the absolute value of the dollar has changed, right? But their mindset hasn't changed. So that number, people get stuck on that number, and then they're classified as cheapskates, right? Because they don't increase their budgets to be in line with how much money they're making additionally, which is the value of a dollar going down and the prices of things going up.
Mm, that's yeah. There's another question there. So, what sort of affordability do you guys aim for in terms of pushing your rents, in terms of rent or to median household income?
Ooh,
So, yeah,
good
good
one.
question.
Great question.
Great question. I wish Chris was here to talk to it.
I know.
Um, yeah, because he'll give you a much more intelligent answer than I will. What I'll tell you is that I don't necessarily look for uh, affordability and do the analysis that way. We tend to partner. Once we have a property under contract or in our management, we tend to work with our PM on the ground there in the area to determine where we can push those rents.
Mhm.
Now, if you're talking about from an underwriting perspective, it's we just base it off market research, and then and then we go pretty soft, right? Like we're like, hey, I think we can see a 4 or 5% increase year over year, and go that way. It's very generic, in those terms, because right now it's a little hard to nail down affordability for these guys because that's the big question, right? It's like where will it break? And let's be honest, at some point it's not going to break, but it'll plateau,
Yeah.
right? Like
At
rents
some
are going to
point,
go.
people are just not going to be able to pay.
Yeah, which is kiki. I think that's kind of the basis of your question, right? Which is, hey, rents are going to do this, this, and this, and then at some point the market will do that to them, right?
Mhm.
So not the individual renter, but the market's going to say, okay, renters in this market, this is where they've topped out. Um, but we're not seeing it at the moment, and based off what we're seeing with inflation, increasing wages, things like that, you're probably looking at a decent, 18 months, 24 months before you start to see that plateau happen.
So to contrast that, and this is why we work well together, is I absolutely go to the citydata.io website and I find the median income. And the median income is updated and changed yearly. So it's more accurate information, and I think that it's valuable. And what do? I take that median income. If it's 50,000, I apply a tax rate of 15%, saying, okay, well, they're actually going to take home 85% of that 50 grand. And the rule of thumb is that somebody should be able to pay 33% of their income, their take home income, into rent. So then you multiply, the 33% times the 85% times the 50, and that's what their yearly spend on rent should be. And if you need to divide it by 12 in order to get into a monthly rental ratio, that will help you understand the market on a macroeconomic level, because that takes into consideration everybody. The class A, B, C, and D tenants all fill into that bucket. Now, what Tim is saying is yes, after you get past that point with the underwriting, you talk to the property management company and say, okay, well, I know that this is kind of what's going on for the market, on a high level macroeconomic level. But what do you think we could do because of
Yeah.
the location and the quality of this property and the demand? And
Yeah.
that's where your partnership with your property management company becomes vital to the success of getting deals under contract. Because if you think you can get 1100 and your property management company knows they can get 1250, your offer price is not going to be competitive enough to get awarded that contract. And I think a lot of people get frustrated over that fact, is they're making a lot of LOIs and they're not getting any deals, but I don't know if they know their markets well enough.
Right.
And I preach it all the time in our mentorship group. One market, pick one market and go into it. Know everything about that market, because that's how you're going to be able to get those really competitive offers and actually be able to get a deal under contract and close it.
Yeah, and that's a really good point. And that's kind of where I was going with that is it's okay to go do that city IO and median income and stuff to get your rule of thumb to get started, right? But then you got to take it a step further, because I can give you an example in Columbia, South Carolina. Like, I know what the median income level is, and I know what that percentage breaks down to and everything. But I also know that there's one section of Columbia, South Carolina, where, forget what that median income tells you. I know in that section you cannot achieve that,
Hmm.
and it's about a 1 mile strip on a particular road, and you will not achieve it. So that's where you can get in trouble by doing that, and where going that extra step of knowing your market, talking to your PM in the area, and understanding that can really kind of save you a little bit. And then
Hmm.
one other thing I would say is, Kiki, I like what you're doing there with your underwriting, and I don't disagree. I Tim and I don't underwrite to 8 and 12 and 20% either.
No, I've never
Um,
done more than 5.
yeah, but that's what I was going to say is, I was like, right now with inflation where it is, you can, I would challenge you to push 4 or 5 on the rent growth. And
Inflation's 8%, guys. So
yeah,
yeah, I
yeah,
mean,
I
4 or
would
5.
I would I would challenge you to maybe go 4 or 5% there. But but again, I will never argue against being conservative.
No, absolutely not.
If you're getting deals at that underwriting metric, then keep it up, man, because
Hmm.
that conservative is never a bad thing.
Yep, absolutely. Yeah, yeah. Whoa, great point. We're I don't really own anything in the Research Triangle. I'm a limited partner in a deal there, but I've never acquired a deal there. Uh,
I've got a couple of things I'm looking at in the Research Triangle. I know it very well. I would love to buy something there. It's been, as you know, it's been off the charts hot. But I focus on the Carolinas. I know the Carolinas pretty well, and then I have about 7 or 8 markets in the Carolinas that I know at a very granular level. So yeah, not just RTP.
Yeah. So I think maybe let me backtrack a little bit and say that when it's picking one market, it's when it's your first deal, right? But I mean, Tim Vest grew up in North Carolina, has been in North Carolina his whole life, so North Carolina, South Carolina is his backyard. After you get the first deal done, you kind of understand the market metrics of the whole state. And if you kind of compare that to like Texas investors, for example, a lot of Texas investors, they invest in all three, right? Dallas, Fort Worth, Houston, and Austin, right? If they can, because it just gives you more access to deals, more variety, a little bit of um, insulation from changes in one market versus the other. You don't necessarily want to buy all of your properties in Miami, right? But you do want to kind of spread it apart, between different parts of Florida, just so that if something happens in one location, like Miami sinks and is no longer there, you have some mitigation of risk by owning property elsewhere. So, I was speaking specifically to the first deal.
And hey, Kiki's on point today, man. And last thing, I don't disagree with you right there. In fact, Chris Jackson was just talking about that this past weekend, about how that it's more like 40. I think he
Really?
said something like 38,
I
39%.
never, I didn't hear that at all.
Yeah,
Interesting.
and he said it in San Francisco as well.
Oh, okay.
About the same thing, about, hey, it's not 33% these days. You can push up 38, 39%. But
Yeah.
yeah.
Awesome.
It,
All right, guys. Well, that's all I got. I mean, I could sit here and talk about this kind of data nerd geeky stuff all day. I absolutely love it. I think it's critical to buying and managing real estate. So I hope you all got some value out of this. Kiki, thanks so much for the questions, for being so engaged. I really had a good time today.
Hey, thanks, guys. And by the way, one more from Kiki. Appreciate it. Thanks. I'm enjoying life after the W-2 for sure. If you guys haven't done it, I highly recommend it.
Yeah, probably one of the best things I've ever done too. So, all right,
So
guys. All right, see you later. Until next time.
take care, folks.